Swayam Prabha. Digital India. Educated India.
In the last class, we spent a lot of time in trying to understand bond valuations. We will do some numericals on bond valuation also after we sort of look at stock valuation. Bond part of it, we talked about YTM, that is yield to maturity. We talked about the current yield. We talked about the zero coupon bond, the pricing of the bond, etc. We will deal with stock valuation. When we talk about stock valuation, there are multiple aspects in a stock valuation, multiple kinds of return what you will get. Typically, if I look at an equity, if I look at a share, equity share, I am going to get return in two forms. One, in the form of a dividend which is directly given by the entity in which I have invested in equity. Second is, for me, I am going to get what is called as capital gain when I sell this equity in the secondary market and somebody buys it at a price which is obviously higher than the price at which I basically bought it out there. That is what we call it as capital gain. So, when you talk about return, return can occur in two forms out there. There can be dividends in a common stock out there. There can be what is called as the capital gain that can occur in a common stock out there. So, these two combined aspect is what we call it as the return that I am getting in what you call it as a stock, a equity or a stock out there, and the cash flows that occur due to these is what we use for valuation. Let us take a base case. Let us talk only about dividends. Let us keep the capital gain away. You are going to buy a stock, you are going to keep the stock forever. I don't think you want to ever sell it. Now, what do you think will be the price of that particular stock out there? All the cash flows that are expected from that particular stock discounted to the today's rate out there is what we call it as the value of the stock. Let us look at a dividend paying stock. Let us look at a stock which consistently pays dividend. The price does not really, the capital gain is almost negligible in this particular case out there. Let us look at, there are many stocks which are public sector stocks which could basically pay a huge amount of dividend where the capital gain is negligible. How do I find out what is the value of the stock? The value of the stock is all the dividends that I am going to get on this particular stock, and imagine it is a consistent dividend paying stock out there. All the dividends that I am going to get on this stock from today till time immemorial in perpetuity, discounted to the rate as a value of today. So, what happens? That becomes the price of the stock out there. That is what we have written also in this slide. The price of the common stock to the investors is equal to the present value of all the expected future dividends. But dividends can also vary in three forms. There can be a zero growth, where dividends is constant year on year, it is exactly the same. There is a constant growth. There is what is called differential growth. Every year that kind of the rate at which the dividend grows is going to be very, very different. It is not constant out there. Now, on the right you see a lot of formulas and everything, formulas and a graph and everything out there. Let us look at the graph. The graph, the x-axis is years, y-axis is dividends per share. And you will see in the zero growth, the constant dividend, basically the line is simple and straight out there. Whereas in a constant growth, the curve keeps moving upwards. Whereas in a differential growth, what happens? There is a low growth, high growth, low growth, high growth. There is a, I have just depicted in the form of a graph out there. Now, what are these formulas? Don't worry about these formulas. We will come to these formulas out there. For example, let me go to the whiteboard out here. Let us say a constant, what do you call it, as zero growth stock out there, zero growth dividend. It's going to be very constant. What is the way you are looking at measuring it? You will see that, what do you call it, as perpetuity. Yesterday we learned perpetuity. What is perpetuity? That is the dividend, the constant dividend by what is called as the discounting rate out there. That will give me what is the value of that stock when we talk about zero growth stock. Whereas when I talk about constant growth, there are stocks which give you constant growth out there. In this particular case, as we can go back to this slide out here, there are stocks which can give me what is called as constant growth out there. The growth is constant, that is year on year, year on year, year on year. There is a same percentage of growth out there. For example, let us say the dividend grows at the rate of 3% every year. Same thing, go back to growing perpetuity. What does it say? Dividend divided by my discount rate minus the growth rate. So very simple. These two aspects become what you call it as quite simple in this particular case out there. That is what you see in the formulas on the right. Sir, for differential growth, there is the formula looks very complicated. Don't worry about it. We'll come back to it. For differential growth, the formula looks very complicated. Don't worry about that. We'll come back to it. The same thing I've explained in the form of what do you call it as a slide out. In the slide out. In a zero growth, because please note, we are ignoring capital gain as of now. We are taking only dividends. We are looking at only dividends as of now. Capital gain part of it will come back later at a later stage out there. If I have to look at valuing the equity, which I am going to hold in perpetuity, I am going to look at obviously only dividends out there. Capital gain part I am ignoring as of now. So what we are looking at in this particular case, in this base case out there, that is dividend in year 1 plus dividend in year 2 plus dividend in year 3 plus dividend in year n, discounted, all these things discounted to the current rate out there. That's all what we say, dividend by growth, by your discounting rate out there. Of course, in the slide I have used R, whereas in the whiteboard when I wrote K out there. That's just a notation out here. Next, I go to the case 2, constant growth part of it. When I look at the constant growth part of it, assume that the dividend is growing every year. Same thing, what we did for growing perpetuity. Since the future cash flows at a constant rate forever, the value of the stock will be represented with dividend in year 1, that is in first year, divided by my R minus G, or what you call it as the discount rate minus the growth rate out there. The next aspect, differential growth. We'll come to this. We'll come to this. Don't worry, don't see the formula and then get a little confused. We'll take up an example. Assume that differential growth. Assume that dividends will grow at different rates in the foreseeable future, and then it will grow at a constant rate. That is, for some years it's going to be what do you call it, volatile out there at different rates. After that, it reaches a plateau out there, straight constant growth rate. Like any industry which is in the growth stage, what happens? In the growth stage, the growth is supernormal. It's very different. It's not consistent. Once it reaches a maturity stage, normally it grows with the industry average at whatever it is. To value the different growth stocks, we need estimate of future dividends, estimate of future stock prices, when the stock becomes a constant growth, and compute the present value of all these things out. So what are we looking at? We are looking at, well, let us look at, focus in this case only on the dividend part out. I'm just going to take an example out here. Martin yacht is expected to pay annual dividend of $1.4, $1.75 and $2 a share over the next 3 years, at least 3 years, respectively. After that, the dividend is expected to remain constant. So that is 4th year onwards, the dividend is going to remain constant. What is the current value per share if the discount rate is 14%? They are not considered again looking at capital gain, you are looking at only dividend based valuation. Let us go to the Excel sheet and try and see if we can calculate this. For a number of years, first year, second year, third year and then beyond 3 years. Beyond 3 years out there. So, let us look at all these aspects out here. First year, what is the dividend? First year 1.4, 1.75 and 2, 1.4, 1.75 and then $2, and beyond that it's going to remain at the constant $2 out there. Now I need to know discount rate is given as 14% out there. Discount rate is given as 14%. Now if discount rate is 14%, what is the discounting factor? 1 by 1 plus 14% out there to the power of 1 in this particular case. Yes, I am just going to do this. I am just going to keep pulling it for 3 years. So, in this particular case, 1 divided by 1 plus 14% to the power of 2 out there, and that is what it is. And third year, 1 divided by 1 plus 14% to the power of 3 years out there, and that is it. I am just going to reduce the decimals to 2 digits or 3 maximum. So, what is the present value of the dividends what you are getting for the next 3 years? The present value of the dividend, present value means today's value of the dividend what we are getting for 3 years is this into the discounting factor into this, and then the discounting factor into this out there. This is the present value of the dividends that I am going to get out here in this case. Beyond 3 years, I am going to get $2. So, beyond 3 years, I am going to get $2. Let us go back here. So, what happens? There is going to be what is called as a zero growth beyond 3 years out. Beyond 3 years, for time immemorial, you are going to get the same $2 out there consistently. So, what is the value of it? The value of it is nothing, it is a zero growth. So, it is nothing but in this particular case, the value of it alone, what we are talking about out here is $2 is what I am going to get, discounted at what rate? Discounted at 14% out there, and this is basically what I am going to get out here. That is the value of the $2 what you are going to get from after the 3rd year, that is from the 4th year till perpetuity, the value of it as of year 3. Value of it as on year 3, as at the end of year 3 out there, as at the end of year 3, the value of this $2 what you are going to get in perpetuity is 14.28. Now, let me do one thing, let me delete this, let me write it in. The value of the dividend that you would receive beyond 3 years is equal to is equal to, what did we say? This is the dividend I'm going to get, constant growth, and this is the rate, this is the one, 14.28 or 2851. Value of the dividend that you would receive beyond 3 years is equal to as at the end of 3 years, beyond 3 years, or I would say that you would receive from the 4th year onwards. From the 4th year onwards is whatever 14.286. This is the value of the dividend out there. This is the value as at the end of 3 years, value of the dividend as at the end of 3 years. Third year, value of the dividend as at the end of 3rd year, value of dividend as at the end of 3rd year that you would receive from 4th year onwards. 4th year onwards, you are going to receive for time immemorial. The value of it and the 3rd year is 14.286. Now what happens? I need the present value of it. The present value, the PV of the constant dividend is the PV of it, because please note this is the value as at the end of 3 years. What is the value of it? The value of it is, as the present value of it is, I just divide by the discount factor for the 3rd year. So now what is the value of the stock? Value of the stock is the present value of the constant dividend from the 4th year plus the present value of the dividend that I am going to get in the 3rd year, plus the present value of the dividend that I am going to get in the 2nd year, plus the present value of the dividend that I am going to get in the 1st year. This is what is going to be the value of the stock out there. Value of the stock, this is basically what I would say is the value of the stock out there. That is how basically we will basically look at what do you call it as the constant. So that is what this basically this basic formula talks about out there. I just did that in a very simple basic exercise. That's what we did. Having said this, let's move to a couple of next rounds of discussions. When we talk about a firm, we say that the return has to grow or is expected to grow. Because the return is expected to grow, what happens? Your stock price grows out there. Now, how do you say that? How can the return keep growing? For example, imagine I invest about 1 lakh in a particular venture, in a particular business. It's a business which has reached a steady state, competition is large, whatever it is out. I sell my I sell my products at a margin of 10%. Margin of 10%, margin on cost out there. Finally, what happens? All these things, it results in my net profit of about, let us say, 15,000 rupees. My investment is 1 lakh. So what do you say? You say, oh, this guy is earning 15% return on investment out there. If it's equity, it is return on equity out there. Whatever. You might ignore taxes as of now, or this 15,000 is after taxes. Imagine tax rates don't change. Your investment is 1 lakh. So what is going to happen? This 15,000 rupees you are going to earn consistently year on year, and the rate, your return on investment is going to be the same 15% year on year. Agreed? So then, how does the price, where does growth happen? How does the price move? Where does growth happen? Where does growth happen? That's a big key question out here. Please note, growth doesn't, so for a growth to happen, somebody will say, sir, my margin on cost, I am not going to be charging 10% out there. I am going to increase my margin from 10 to 11% out there, then growth is going to happen. Please note, if I increase my margin from 10 to 11%, I will be out of business because the competition is so stiff and what you call it as, I am operating in a very mature market where I just cannot increase the price more. Rather, I will have to go at looking at reducing this 10% to even smaller, thinner number out there so that I can sort of beat the competition out there. So, increasing it is not. Sir, increase the volume. Agreed, volume will increase, but it's a competitive market. Market is almost saturated. When I say saturated, in the sense saturated by your capacity. Please note, let me also make that very clear. Market is huge, but I can make only about say 10 lakh pieces and sell it. I cannot make, I'm operating at full capacity. I cannot sell more. Though the market demand potential can be more, I cannot sell more because my capacity is reached. So very simple, increase the capacity. If I increase the capacity, then what happens? My investment also has to increase. If my investment is going to increase, then naturally, of course, yes, I don't deny that. Then I'll say, instead of one machine, I'll put two machines, so I'll make exactly double. Then what happens? My 15,000 becomes 30,000 out there. My investment instead of 1 lakh becomes 2 lakhs out there. So what happens? The return is the same 15% out. What you're getting? It doesn't change. How does growth happen? Growth normally happens, if I have to say that, growth happens because of what is called as increase in your, of course, equity or what do you call investment. So that's what we said, increase investment, put one more machine. No, I am not looking at what you call it as raising new capital and putting in, augmenting the capacity. No, not that way. For example, imagine in the first year I had an investment of 1 lakh out there. My net income is 15,000. I distribute this as dividends. Imagine I do not give this as dividend, no dividend. Then what happened? In the second year, my investment will be 1 lakh plus 15,000, 1 lakh 15,000. Imagine I earn the same 15% return on my investment. I earn the same 15% return on my investment. 15% return on my investment. Then what is going to be my net income in the second year? It is going to be 15,000 on this plus 2,250. Am I right with the number? 225. 15 into 15.
1 lakh 15% is 17,250.
So what happens? 15,000 plus 2,250 is 17,250. And that is exactly what I said. So what is happening? There is a growth. The growth is here. The 2,250 is growing. Why that is growing? Because of this is growing. Sir, you have to have avenues. Yes. My capacity is reached. You said, yes, capacity is reached. No, because I have made further investment. I can do some treasury operation. I can park the fund which can earn more. I can move to a new market and sell new products because I am investing more. I can increase the packaging a little bit, whatever it is, my appeal of the product. I can get more. So what happens? You are making an additional investment out there. The additional investment is because you did not give dividend and you retained your net income out there in the case. So typically growth comes from how much of money is being reinvested. How much of money is being, how much of money is being reinvested in the business? How much of money is being reinvested in the business out there? So typically when we say growth will depend on retention ratio. That is, what is the percentage of the net income that the company retains? Because you are not distributing entire net income as dividend, you are going to distribute only part of the net income as dividend, part of it you are going to retain. So what is the percentage of net income that retains? For example, my company has a policy of retaining 60% of the net income. So my retention ratio will be 60%. Now, the belief is this 60% what I am retaining and reinvesting will also earn at the same rate at which my original capital earns out there. This can have sometimes what happens, the additional retentions what you make may not get the same kind of return as your original capital, might get a slightly lower, because for original capital you are manufacturing some product and selling. This money you are using it for some improvements out there. You may not get the same kind of return, possible. So what happens? Whatever earnings that is going to be there, whatever amount of money that you are going to retain, what is the rate at which that is going to earn? Here in this case, base case, vanilla case, I am going to assume it earns at the same return on equity. So growth comes in only from retention ratio number 1 and the return that the retention ratio is going to earn from in the market out there. So exactly that is what I have described it in my slide out here in this particular case. The value of the firm depends on the growth rate and its discount rate, of course. Growth depends on retention ratio, how much of money you are going to retain within the firm. The profit, how much of it you are going to distribute it to the shareholders, how much of it you are reinvesting. Some Microsoft would say at some stage, some years back, they said 100% is retention. I am not going to distribute anything, I am going to keep on reinvesting because there is a need for more and more money, more and more investment required. Naturally, what happens? That money what you are retaining, assuming that it's going to earn at the same required return on the retained earnings out there, whatever is the return on retained earnings, assuming that you can assume it's the same rate or it can be differential rate out there. That is what is growth going to be. Growth is going to be, if I have to say that again, growth is going to be the retention ratio multiplied by the return that this money is going to earn. The return that this money is going to earn, the return, that is the retention, whatever money you are retained, that is going to earn out there. That is where growth comes in for a firm out there. Discount, of course, a rate can be broken into growth rates and dividend yield, etc. out there. I am not getting much into the estimation for the dividend part of it. Let us keep that our part, the discount part of it, the dividend discount part of it aside for the time being. We will come to the discount part of it more and more when we talk about cost of capital, which is at a much later stage. We will talk about cost of capital, that is where we will talk about the discounting rate and so on and so forth out there. As of now, keep the growth rate intact out here, and with that, that is fine. Now let us look at, there are other equity valuations that also we use. We use PE multiple or PE multiple. I won't even call it PE ratio here. I am going to correct it. I am going to look at it as PE multiple out there. I am going to keep it as PE multiple in this particular case, price earning multiple out here. So the price earning multiple is nothing but price per share by EPS or whatever it is you can say, or whichever combination. That means your company has earned X dollars or X rupees. how much is the multiple that you will give? How many times that earning is what you are going to give as the price of that particular equity. That is what is price to earnings multiple. That is what they will call it, price to earnings. The earnings is there per share, EPS, earnings per share. How many times earnings per share should be the share price out there? That we use it for comparable companies. Imagine I have a listed entity. Market price is available. I know EPS is available. I know what is the price earning multiple. How many times the earnings is the market price? I have somewhere idea. Average 6 months. I have an unlisted entity. Exactly in the same business, same size, etc. Now, the unlisted entity is looking for some investments and I have to throw in some money into that unlisted company. Buy equity shares. What price do I buy? I can look at the listed entity, use it as a proxy to get a ballpark figure. Let me use the term out. Let me give a range of figure at which I can look at investing in the other firm out there, and that is why PE multiples are basically used. That is where he said equity valuation using comparables. Next we look at enterprise value and EBITDA. Enterprise value is equal to the market value of the firm. Market value of the firm is whatever is the share price multiplied by the number of equity shares out there, plus the market value of the firm's debt minus basically cash out there. That will give you what is the enterprise value. Enterprise value, what is the enterprise value? How many times is the enterprise value to EBITDA? Earnings before interest, tax, depreciation, amortization. Why D&A? Depreciate, because depreciation non-cash outflow, amortization non-cash outflow expenditure. So earnings before interest, tax, depreciation and amortization out there. EBITDA, enterprise value. What is the percentage? This is what the company is earning. What is the value of the enterprise? Value of the enterprise is market price per share into number of shares plus the value of all the debt that is there minus the liquid cash that the liquid cash and marketable securities that the company has. That is the enterprise value. How many times the EBITDA is the enterprise value? That again I look at comparables. So enterprise value to EBITDA ratio. So this gives you some basic idea about the stock valuation. I have not looked at capital gain. Please note, I have not looked at capital gain. I will come back to capital gain and then valuation of equity at a later stage when we go on. We looked at bond valuations. Let's try and see if we can solve some small numerics out there on this. Small numbers, couple of numbers out there. I got a complete list of problems and let's take that as we go along.